Welcome, everyone. Thank you for joining me today for this special presentation of key financial data for 2022. It's our first webinar of the year, and we'll cover taxes, tax rates, thresholds, limitations, exemptions, and more. So I'm the founder. My name is Mark Bautis. I'm the founder and owner of Bautis Financial. I have my colleague Kira on. If you have any questions during this webinar, please enter them in the chat or Q&A. We'll have some time for questions at the end. If you go to our Learning Center, you can see replays of all the webinars that we hosted last year, in addition to being able to register for upcoming ones that we have planned for this year. Our next one is going to be a look back at 2021 and what we can expect in the markets and economy for 2022. Okay, so before I get started, just a quick disclaimer that we are going to be talking about taxes, about finances, and while I'm a financial advisor, I may not be your financial advisor. So before you make any decisions based on the info we talk about, consult with your financial professional. All right, so 4 years ago, Republican-led Congress approved the most far-reaching tax legislation since 1986. It was called the Tax Cuts and Jobs Act, and it really managed to turn 100 years of tax law on its head. A really big change to taxes. Not to be outdone, however, a year later, Congress passed the Secure Act, which drastically changed rules around inheritance of retirement accounts, as well as other retirement areas, especially for non-spouse beneficiaries. Then the ink was barely dry in the Secure Act when the COVID-19 pandemic started, became an international tragedy, and that sparked a different variety of stimulus measures passed in 2020, which addressed a lot of the economic challenges that the pandemic brought to us. So we have a lot of different changes that have gone on in the past couple of years, but then that brings us to where we are now. And the Biden administration last year put forth the Build Back Better bill. This actually passed the House November 19th of last year. However, as today, the Senate is currently debating the bill. So it went last year. There were a lot of proposed tax changes in it. A lot of them didn't make the cut. So we're not going to see an increase in the top marginal tax rate, nor the capital gains rate. And there's also no change to the estate tax exemption and the billionaire's tax that were proposed. So what is in the bill? And mind, you got to realize that this may all change by the time this gets passed, or none of this may get passed. So it's really a TBD on what we're going to see in terms of tax changes for 2022. But what is currently in the bill that's being debated? Roth conversions of after-tax funds in retirement accounts would be prohibited for all taxpayers starting January 1st of this year. So this is the common backdoor Roth IRA that a lot of people do. If the bill was going to pass in November and December, this would not have been allowed this year, but the way current law is, it still is allowed. Also prohibited would be any Roth conversions for taxpayers in the highest ordinary tax income bracket starting 10 years from now, or January 1st of 2032. The bill also imposes RMDs, or required minimum distributions, on large account balances if someone's taxable income is greater than $450,000 a year if you're married and filing jointly, $400,000 if you're single, and the combined value of any IRAs that you have or defined contribution plans is greater than $10 million. So what the government is saying here is you've built this really big retirement account or accounts or retirement portfolio, and they're going to start forcing you to drain that maybe at a different pace than normally your RMDs are, which start at age 72. Also, if you're in that bracket of that 450,000 married filing jointly, 400 single file, if you're a single filer, you would be prohibited to do any traditional or Roth IRA contributions as well. The other thing that's in there is the cap on the SALT, which is state and local tax, would be $72,500, up from $10,000 where it is now. There would be a 5% surtax if your modified adjusted gross income, or MAGI, is over $10 million, and an additional 3% surtax if your modified gross income is over $25 million. So it's really, like I said, it's unsure what if this bill will pass, what its final version will look like. but just wanted to go over some quick things to keep in mind. But for now, let's actually look at what the IRS has told us for 2022. So the big news, or one of the big things to look at, are the tax brackets and tax rates for 2022. And really, we've put a lot of focus on tax bracket management. It's one of the areas where people can really optimize their financial situation, financial planning. There's still 7 tax brackets in 2022, along with the 0% tax rate. So let's run through them quickly. So here are the tax brackets and rates if you're a single filer in 2022. The lowest tax bracket you can see goes up once you hit that $10,275. So, and then also single filers with a taxable income over $539,000, that puts you in that top 37% tax bracket. And one thing I think that always gets confused is the marginal tax bracket versus effective tax bracket. But one thing I wanted to say is that even if you're in the highest tax bracket, that 37% tax bracket, that doesn't mean that all of a sudden now all of your income gets taxed at that bracket. It still goes through these different stages that you see here. So from zero, if you're from your first $10,275, there's 0 tax on that. Now, once you go into that next bracket, 10,276 to 41,775 is taxed at a 12% rate. Then if your income is still overflows and is into that next bracket, you're taxed at the 22%, and then 24, and then 32%, and so on. And so what that's really showing is that you're not, it's not that you automatically flip a switch and all of a sudden, if you go into a higher tax bracket, all your income is taxed at that. Marginal tax rate means what is your next dollar taxed at, what rate? So I just wanted to give a quick explanation of that. Here are the brackets if you are married for filing jointly and for surviving spouses in 2022. So here you see the lowest tax bracket goes up to $20,550. And then the highest, that 37% tax rate, is if your income, your combined income, is over the $647,850. So one of the things I mentioned in a couple of slides ago is how tax bracket management, how you can be, how you can look at it from a planning perspective. And one thing I wanted to cover is how Roth conversions kind of fit into this. So let's say someone, a retiree has, they're in that 12% bracket. So their income, maybe from Social Security, maybe for some RMDs is under that $83,550. One thing we would look at and say, well, if we maybe converted some of your IRA over into a Roth and didn't bump you up into that next 22% tax bracket, we're still converting at a 12% bracket, which is pretty, in the grand scheme of things, it's relatively low. So what we do have a strategy is called filling up the bucket. So let's say the total income is $75,000 that someone has between Social Security, any other income they have, and their RMDs from their IRA. We would then say, all right, 83,000 minus the 75, we have about 8,000 that we can convert and know that we're paying it at the 12%. We're converting it at the 12% bracket, versus if we just said, well, let's convert 25,000 of it. We know that some of it, there's a big jump. They're going to convert it at 10% more at that 22% bracket. So if you look, you can see where in the rates are there big jumps. There's a big jump from 12 to 22. There's not so big a jump from 22 to 24. Pretty sized jump 24 to 32, and a pretty sized jump again from 32, 35, 37, depending upon where someone falls on that. But that's one of the areas that we look at and see, do Roth conversions, do filling up the tax bracket bucket make sense. Here we see tax rates for head of household if you're filing at this, and this is somewhere in the middle of if you're filing single and if you're filing married filing jointly. And here's I think the last one we wanted to cover is actually the married filing separately. So here you see the lowest bracket goes up to $10,275, and then if your income's over $323,000, you're in that top 37% tax rate. And usually it makes sense to, if you are married, to file jointly, but there are some situations where it may make sense to file separately, which depending upon your personal situation, we can go over. And then lastly, here's the rates for estates and trusts. So you can see you're pretty much at that high tax bracket once the estate or once that trust hits or estate is over the $13,450. So There are definitely reasons why you want to use an estate or why a trust would come into play, but you can look at the tax rates when you compare them to some of the other filing statuses. Trusts are definitely have a high tax rate that they have. All right, so now let's talk about standard deductions for the year. So the standard deduction, it increases slightly from 25,100 in 2020 to 25,900 in 2022. And that's if you're married filing jointly. If you're single and married filing separately, it goes from 12,550 to 12,950. And really what this is, the standard deduction is, it's kind of like your freebie. This is how much income you can have, and you're just without any questions asked, you're able to deduct that and not have to pay income tax on that. But you have to remember this: the ability to take personal exemptions, it's been eliminated. So what we see is that a lot of, or most of the people are using this standard deduction versus itemizing. Okay, now we're going to look at a couple of credits that are out there. So for 2022, child tax credit, it's $2,000 per child, with $1,500 of it being refundable. And I'll explain what that means. But to be eligible, your income has to be under $400,000 if you're filing jointly, and $200,000 for all other statuses. And really, what the refundable is, it's a really good type of credit. It means that it could even create a possibility of a negative federal tax liability. So let's say you don't owe any taxes, and you have this $1,500 refundable credit. That means you'll actually get a refund back from the IRS for $1,500, where some types of credits, which are non-refundable, means that you can never go below owing, you're never getting money back. You may get to that owing zero, but you're not going to get money back from the IRS for certain types of credits. Okay, now we'll talk a little bit about capital gains and qualified dividends. So tax rates on long-term capital gains, qualified dividends, they're for the most part unchanged right now. And again, this is what some of the talk in the bill from last year did initially have changes, which got revised in the last bill. But they're right now at 0%, 15%, and 20%. So these are what we're still at for 2022. The 15% is probably the most common one. It applies for capital gains and dividends when your income is above $83,350 if you're filing jointly. The 20% rate applies if your income is over $517,200 and you're filing jointly. And you can see also the brackets if you're single or filing at those different statuses. So again, the way capital gains work are 15%. However, if you're over that 517, you get charged an extra 20%. And capital gains long-term means if you held the asset for over 1 year. So that asset could be a house, it could be a rental real estate property, it could be a stock, it could be cryptocurrency, it could be anything that the IRS considers an asset. If you, and just one thing on short-term capital gains, if you hold them, that's if you hold the asset less than a year, and those are taxed at ordinary income rates. Okay, now we'll cover some additional taxes, which may be relevant to some, all of you. First one is the alternative minimum tax. So what this is, this puts a floor on the percentage of taxes that a filer or taxpayer must pay to the government, no matter how many deductions or credits that they claim. So some people, can really lower their income that they're paying tax on. And what the IRS has come and said, you know what, you can do that, but we're going to put a floor that it's kind of this alternative tax system that they have where they still want to be able to collect tax. So it's been adjusted for inflation for 2022. It will continue to affect fewer and fewer taxpayers under the Tax Cuts and Jobs Act. The exemption amounts rise to $118,100 if you're married filing jointly, which is up about $4,000 from 2021. So, if you're over that amount, you are going to get hit with AMT. All right, so net investment income, and really what this is just an additional tax that's on some high income taxpayers. And really it's a 3.8% additional tax, which it's levied on the lesser of the net investment income, or MAGI, modified adjusted gross income, when you're over $200,000 if you're single, or $250,000 if you're married filing jointly. So these amounts are the same for 2021. And really what goes into this calculation is taxable interest, ordinary dividends, capital gains, and pretty much any other income, although some expenses can subtract out of it. But again, it's just another, at one point this was called, I think, the Medicare surcharge tax, but it's just another tax if your earnings are over a certain amount that you have to pay. All right, so any changes to gifting and estates tax for this year? So estate gift and then the GST exclusion, it goes up from 11.7 million in 2021 to 12,060,000 in 2022. The top federal state tax rate remains at 40%, and the value that you see the gift tax annual exclusion of 15,000, so that stays the same at 15,000 for 2022. Gifting is one of the best ways to pass assets down to generations. So really what this says is that any one person can give any other person up to $15,000 per year. And there's nothing that has to be filed. And if there's a husband and wife, they can gift up to 30,000 to one person. That one person, it doesn't have to be related. They could be related. It's really any other person. Sometimes you see grandparents gifting to grandchildren. One thing that I had talked about a little bit about last year were I bonds and their rising popularity. We're seeing that a lot where whether it's parents, grandparents, gifting I bonds to kids, and so that's something that you may want to look into. And then the other thing too is that unlimited payments for tuition and medical expenses are permitted. So no change to that as well. Okay, now we'll talk a little bit about some education credits and the deductions. So just as in 2021, 2022, taxpayers with qualified education expenses, you can reduce your tax bill up to $2,500, of which $1,000 that is refundable, and that's as part of the American Opportunity Tax Credit. There is income limits on this, so this is you're only eligible for this if your modified adjusted gross income does not exceed 80,000 if you're single, 160,000 if you're married filing jointly, and then at those income levels, the credit does start to phase out. So the way this, its acronym AOTC works, it's a credit for qualified education expenses paid to an eligible student for the first 4 years of higher education. So you can get that maximum annual credit of $2,500. And then again, if that credit brings the tax amount you owe to zero, you can still have 40% of that refunded back to you. So again, it is a pretty good tax credit if you are eligible for it. The other education tax credit that is lumped into there is called a lifetime learning credit. So this is a non-refundable credit worth up to $2,000 a year. And in 2022, this credit starts to phase out for taxpayers with a modified adjusted gross income of 80,000 and then the same 160,000 if you're married filing jointly. The lifetime learning credit, it offers two main advantages over the one we just looked at, the American Opportunity Tax Credit. So this one, it can be claimed for unlimited number of tax years, whereas the AOTC, it's limited to 4 tax years per eligible student. And the other good thing is that with this one, the student doesn't need to be pursuing a degree, whereas the AOTC requires the student to pursue a degree or some other type of a credential. So this one, the way it works, the LLC or lifetime learning credit, it's for qualified tuition and related expenses for eligible students enrolled in an eligible education institution. And it can be used to pay for undergrad, grad, professional degree courses, even including courses to acquire or improve job skills. And there's no limit to number of years that you can claim the credit. But the thing is, you cannot claim both credits. So you can't claim this and the American Opportunity Tax Credit for the same student for the same year. So you just have to look and see which one makes more sense, which one are you, of the two are you eligible for, and then make a decision on which one to utilize. Okay, 529s, again, very, very popular. So as in 2021, the way the rules work are you're allowed to use up to $10,000 a year of 529 plan distributions to pay qualified private school K-12 education costs. Does not include homeschooling, but it's a reason why a lot of people are focusing more on 529s versus Coverdell's. Previously, the 529 distribution could only be used for higher education costs, college, basically college, whereas now the K to 12 expenses can be used from a 529. So we're seeing a lot of planning going involved in there, and that and the other thing about 529 is that a lot of people don't realize is you can actually front load a lot of them. So you can front load up to 75,000 per child per person, contributing up to them. And what you're doing is you're knocking out 5 years of that gift tax, that $15,000 limit. So, and then people are planning to use them from, if they do have kids going to private school, but also how strategically can use them for K to 12 plus college. And the whole reason for using 529s is the money that you put into them, as long as it is used for education, you do not have to pay tax on any of the gains that happen in the account. So there's definitely a benefit for using them. All right, now retirement plans. They some of that legislation we looked at with the Tax Cuts and Jobs Act, the Secure Act, and also in the Build Back Better bill. A lot of it is on retirement plans. And there's also talk that we may see Secure Act 2.0 at some point. So retirement plans remain focused. There's changes to 401ks. There's changes to limits. But let's look at some of what's going on with retirement plans. So the total amount that employers and employees combined can contribute to a 401k or a similar defined contribution plan. A defined contribution plan, think of like 401k or SEP IRA. The other type of plan is called a defined benefit plan. And that's really like your pensions or your cash balance plan. But that for the defined contribution plan, your 401k, 403b, that rises to $61,000 in 2022, up from $58,000 in 2021. So, and then the limit on how much compensation can be counted under a qualified plan, it's gone up from $290,000 in 2021 to $305,000 in 2022. And just as a reminder, RMDs do not start until age 72. This was previously it was age 70 and a half. The IRS would start to force you to take money out of your IRAs or your retirement accounts. And the way that the RMDs work at a high level is they look at the balance of that account on January 1st. They look at your age, and there's a calculation that has to be done. And what it does is it spits out a number that says by December 31st of the end of the year, you have to take out X amount from your retirement account. And the whole reason they do that, and they say you have to take it out, is because once it comes out, it gets taxed at ordinary income, and the IRS can now collect their money that has been deferred. The tax has been deferred in while it was in those tax sheltered retirement accounts. So it's a way for the IRS to collect their money. Nothing changing with that. We did have 2020 where RMDs were not allowed. Last year, 2021, was we started to have to take these again, and now going forward, they'll have to be taken every year if you're eligible or if you're required to take them. Okay, so in 2022, as in 2021, if you're saving for retirement in a traditional or Roth IRA, you're still going to be limited to that same amount. No bump up here. $6,000 contribution. If you're over age 50, that bumps up. You're able to contribute an extra $1,000 to contribute. And one of the other changes that were in the Secure Act is that now there's no age limit on your ability to contribute to an IRA as long as you have earned income. So as long as you're showing income, you are still able to contribute to an IRA. Whereas previously, once you hit 70 and a half, the IRS said you can no longer contribute. So, and there's like this, and see if this income limits column at the end of this, there is a caveat on contributing and deducting your contributions to IRAs. So if you want to contribute to an IRA and want to take a deduction for it, if you're not covered by a plan, that's fine. If you are covered by a plan at work, meaning like a 401k, there are income limits where you can deduct that contribution. So you can see these on the right here, and it actually depends on whether you or your spouse or neither are covered by plans at work. So we have a flow chart that we go through when it makes sense for someone to make a contribution, just to confirm whether or how much or does it phase out their contribution. So you definitely do want to check and make sure that you are eligible to make that contribution and get the credit, get the deduction for doing it. All right, so now let's cover some health numbers for 2021, which includes things like HSAs, long-term care premiums, and then Medicare numbers for the year. So health savings accounts, if anyone's heard any of my webinars or talks, one of my favorite types of savings plans, because you get the tax trifecta, triple tax trifecta. The contributions are made pre-tax. They can go into this tax-free investment account, and then money comes out tax-free if you use it for qualified medical expenses. So if we just recap on that, deduction, deferring tax, and then it comes out tax-free. If we compare it to like a traditional IRA, you get the deduction up front, but you have to pay tax when the money comes out. If we compare it to the Roth IRA, no deduction up front. You pay tax on that money, it goes in, and you get the tax-free as it comes out. So here, we're getting the benefit on both sides of it, which there's probably nothing, very few, if anything, where you're allowed that triple benefit. So just to go over what we're looking at for 2022, minimum annual deductible for a qualifying plan, healthcare plan is $1,400 for an individual and $2,800 for family coverage. So you can't, and not just anyone can go use a health savings account. It has to be attached to a high deductible healthcare plan, and that is what that $1,400, $2,800 is. Your deductibles have to be a minimum of those, whether you're single or a family. The maximum deductible contribution that you can make to an HSA in 2022, it's $3,650 if you're an individual, and then if you're a family, the maximum amount is $7,300. And then there's that same $1,000 catch-up contribution if you're 55 or older. So if you're eligible for HSA, if you have the ability, one thing you do want to do is compare it to your, the high deductible versus a regular plan, and just make sure that the high deductible makes sense. But if it does make sense, definitely take advantage of that HSA if you can. Okay, so taxpayers who are paying for long-term care, they generally can deduct a portion of their premiums as a qualified medical expense. The deductible does vary based on the taxpayer's age, and it's subject to that 10% floor for medical expenses. So if you have a question on whether you can use long-term care premiums and get a deduction for them, be happy to take a look. You can obviously always ask your CPA if you're eligible for that as well. Now, Medicare premiums. So as in previous years, in 2022, the income brackets used to determine Medicare premium surcharges for high income retirees, they're indexed for inflation. So they do shift a little bit. And what actually, as a result, some retirees may experience a reduction in their Medicare surcharge costs next year. So the standard premium amount in 2022, it's $170.10, though some Part B beneficiaries actually pay less due to the hold harmless provision that protects them if their Social Security benefits rise slower for the cost of living adjustment than the Medicare premiums do. So you do want to just check and see if you're under that category. The people who pay the higher figure here that we're looking at include those signing up for Medicare Part B for the first time, those who don't receive Social Security benefits, those who don't have Part B benefits automatically deducted from their Social Security benefits, and there's some others that fall into there. And then also some high income beneficiaries, they'll pay more than the standard premium, as you can see here. And that's based off of that modified gross income that looks at. And what it does is, you have to remember, it actually the premiums apply to income from 2 years prior. And the decisions that you make now, it has a future impact. So one thing you do want to look, and one thing we've done before is help people, basically dependent upon their situation, challenge what that premium is. There's always been extenuating situations why maybe 2 years ago something happened and you may have shown a lot of income, whereas now you don't have a lot. So you do want to look into what you're paying, where you fall into this, and then also, are there other options to challenge it and maybe not have to pay that surcharge. All right, so the next naturally is Social Security. So here are some numbers that pre-retirees and retirees should be aware of for 2022. So just as some info, the estimated maximum monthly benefit, it's $3,345 in 2022, which is up slightly from $3,148 in 2021. And the maximum taxable wage base in 2022 is 147,000, up from 2021's 142,800. So what that means is that's how much of your income is has Social Security tax on it. So, and that's up to your first 147,000. So if your income is above that, the income above that you're not paying Social Security taxes on that. And that tax rate is the same. So 6.2% each for the employer and the employee. And then if you're self-employed, you're paying the full 12.4%. So the full or normal retirement age for claiming unreduced Social Security benefits, it's 66 if you were born 1943 to 1954. If you're born after 1954, but before 1960, full retirement age is 66 plus some months, depending upon your birth year. If you're born in 1960 or later, your full retirement age is 67. And I've done a lot of talks, webinars on Social Security, which again, you can find at that Learning Center, but it talks about, when does it make sense to, not, to wait later to claim, or how to coordinate spousal benefits. So there's a lot on Social Security planning that I do have in that Learning Center. Sometimes retirees, they're surprised that their Social Security benefits are taxed. So we know that you're being taxed as you're working on your income, but also when you're receiving Social Security benefits, most likely you're going to have to pay some tax on them. So what this slide shows here, it's the income thresholds at which benefits start to be taxed. And you really, to figure your bill, you must compute all of your provisional income, which is known as your combined income. So that's income, non-taxable interest, and then half of your Social Security benefits. So that may be, you might have rental income, you may have pensions, you may have IRA distributions, you may have capital gains. You really lumping it all together, and depending upon where it falls, that's how much of your Social Security benefits are taxed. So you see on the right side, you see up to 85%. That doesn't mean your Social Security benefits, you're going to pay an 85% tax rate on it. It just means that up to 85% of what you're receiving for Social Security may be taxed. But it's just, I think for some people it comes as a surprise that a lot of people think that the benefits are non-taxable. Okay, so our tax code, it's evolved from way back 1913, a 2-page form, and I know there is a push out there to go back to that. Probably not happening, but right now the IRS code, or the IRC code, it's 75,000 pages of rules that are constantly changing. So we covered some of it today, tried to summarize some of it. What this whole presentation is based off of is a key financial data card that I publish and send out. One year I didn't do it, and I received a lot of feedback from people where they were looking for it. But it really just helps you keep track of the key numbers that do have an impact on your financial life. So you can go to our website, you can download a card from here. If you send an email to us, you can send to askanadvisor@bautisfinancial.com. We'll mail you a physical copy of it. Some people like having the hard copy. Some people like referencing it. Also, if you go to our website, we have a search bar where you can just search in key financial data and it'll pop up on there. So I wind up doing that a lot. I reference this a lot as well, just in the planning and strategy sessions that I have with people. So, going through this, it may have brought up questions about your specific situation that you may have. You may want to have some more clarity on specific things. I'm happy to schedule a time where we can discuss for example, maybe whether a Roth conversion and how you can best use your tax brackets, or a gifting strategy, and how could you implement that without worrying, an amount that you're comfortable with that's not going to impact you from down the road. So we're not CPAs, we don't prepare tax returns, but we do have the ability to analyze your tax situation, the ability to analyze a tax return, determine if you're missing out on any deductions, credits, whether you can take advantage of different planning strategies. So again, you can go to our website, top right, there is a link to schedule a call with us. It's a free consultation. I'm happy to do that as well. So right now I'll just open it up to Kira. Is there anything that we have, any questions right now?
Hey, Mark, there's actually no questions in the chat today.
Okay, perfect. So I just want to thank everyone for their time today. And then just like I said, remember, I'm available to meet when I have any questions about the specific topics, how they really impact you. I'd be happy to talk and happy to share a key financial data card with you. So again, thanks again.